So foreclosure filings are picking up now. I told you that was going to start to happen. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is the 10th of November. I'm Randy Patrick, putting the realism back in real estate. Hope you're doing well. We're going to get involved in some more foreclosure stuff today. I know I talked about some of it last week, and it just so happens that another article came out yesterday, so we're going to talk about it. I'm not just zeroing in on foreclosures. There's a lot we can talk about with respect to housing these days, but as far as I'm concerned, you know where I'm going with my platform here, and I think it's something we all need to be aware of, as opposed to just how high prices are rising these days. I mean, we know that's what's going on, but there's obviously there's where you've got the one end, there's the other end, and we got to take a look at that. Remember, K-shaped recovery going on here, right? We got stuff going at the I call it like metro bubbles now. We have metro bubbles that are happening as opposed to a national bubble, and it's about how those are all going to play out. So, as I said, hope you're doing well, and if you're not already a subscriber, if you could please help my channel grow and subscribe, that'd be most appreciated, and I thank you very much for watching. All right, guys, let's get into it right now. So Adam Data Solutions, all right, U.S. properties with foreclosure filings on the rise as pandemic remains a threat to the economy. So this is the scoop here. What we're basically seeing is the fact that foreclosure filings in October 2020 up 20% from last month. So that's news, I guess you could say, and there's some twists and turns that go along with that. But I think just for the baseline, it's things are starting to loosen up, and that's probably, I think you could say, the real reason why things are changing now. It boils down to the fact that it was a little surprising to see foreclosure activity increase in spite of various foreclosure moratoria that are in place, said the vice president of Realty Track. It's likely that many of these properties were already in the early stages of default prior to the pandemic, or are vacant and abandoned, which makes them candidates for expedited foreclosure actions. So that is kind of true, but I want to make sure that everyone understands that, we do have levels of moratoria going on, right? Moratoria, plural for moratorium, obviously. We've got the FHA moratoria, which is FHA-backed government-backed loans, which really is in place to the end of the year, December 31st, 2020. And then we have the CDC, Center for Disease Control moratoria, that's in place. And then you may have your own state moratoria in place, moratorium. And, some states are relaxing on the local or the state moratorium. I know where we are in Florida, our governor basically said, you know what, I don't have to extend the state level moratorium because I'm going to fall in line with the CDC because it's already out there. Why do I need to duplicate it? Which is interesting because the CDC doesn't really go into the depths as the state level did. And thus what we're seeing is a lot of properties are starting to hit the foreclosure auction block now, get scheduled for auction, because the CDC moratorium is more focused on tenants and tenants proving that they do have financial hardship due to COVID-19. That's where things are going with respect to that. So just keep that in mind, that when you hear these moratoriums and you can't evict me or can't foreclose on me, things have changed over the past few months. I know that there are people who believe they're still protected. I know there are renters or tenants I speak with who you may think that they're untouchable, and that's not the case anymore. So you really have to understand what's going on in these different levels of moratoria and where you actually live. All right. So interesting enough, when we take a look at what Adam Data Solutions is saying, and this is where I talk about, it's all based on jurisdiction, local court, like I guess you could say customary procedures, whether you're a judicial state or a trustee state, etc. So South Carolina, Nebraska, and Alabama post the highest foreclosure rates. So nationwide, basically 1 in every 11,683 housing units had a foreclosure fund in October 2020. States with the highest foreclosure rates were South Carolina, Nebraska, Alabama, Louisiana, and Florida. So there you go. So when I look at this, I go, well, I can see South Carolina because there's some depressed areas, South Carolina, and I know that they're a judicial state with respect to how their court cases work. Nebraska is the one I'm kind of going, okay, it's that one was a sleeper. Alabama, a bit of a sleeper. Louisiana, yes, because Louisiana is always hit by a higher default rate and FHA and everything like that. Florida, of course, I live in Florida. I know exactly what goes on down here, so that's certainly what's happening. Additionally, among the 220 metro statistical areas with a population of at least 200,000, Those are the highest rates. In October were Peoria, Illinois, so we're going to the metro level now, Champaign, Illinois, Beaumont, Texas, Birmingham, Alabama, and I don't know how to pronounce this, like Houma, Louisiana. So again, when you're taking a look at where this is happening, you're seeing Illinois, of course, Texas, maybe Beaumont, I think is on the other side of Houston, I believe, which may have had some issues with some of the natural disasters. Louisiana area, Birmingham, Alabama, possibly. I'm not too familiar with what goes on up there. So that's the scoop. Now, in the last paragraph here, those metro areas with a population of at least 1 million, you've got Birmingham, Alabama as well, Cleveland, Ohio, Jacksonville, Florida, New Orleans, Louisiana, and Miami, Florida. So I can tell you that, in things like Cleveland, as we know, has tons of underwater properties, and they have zip codes that lead in foreclosure filings, etc. Birmingham, again, looks like it's having some problems. Anything in Louisiana is not surprising. I look at going Jacksonville. Jacksonville's jumping up there. And Miami. Miami is just sheer volume. And I can tell you that Miami is going to have, on average, the past couple of years, 5,000-6,000 foreclosure filings a year on a slow year. All right. So keep that in mind. Now, this year, obviously, for every location, we'll have slower or lower foreclosure filings because of the moratoria across the board. Once it's lifted and things change, we're going to see that pick up as it's starting to right now. So interesting. All right. Foreclosure starts increase monthly nationwide. So basically, they take a look at foreclosure starts, including Idaho, up 109%. Now, foreclosure starts are, as I said, that's filing a foreclosure, right? So whether it's notice of default or the lawsuit style, which is lis pendens, notice of lis pendens, the foreclosure filings, that's what I look at, is the fact that we can have foreclosure activity, which includes, sales and auctions and whatever, but the starts are really an indication of what's happening, what's going to happen with a defaulted client or a homeowner who's not paying their mortgage and they're now in the foreclosure pay count. So it basically looks like Idaho's up 109%, Nebraska 56%. I'm trying to think. North Carolina up 294%, Ohio 74%, Illinois up 30%, New York up 24%, South Carolina up 18%. So again, it's just how they look at it from states. Metro areas greater than 1 million people. New York was up there for foreclosure starts. Illinois, Chicago, Illinois, Los Angeles, Miami, and Houston. So we're seeing the paid counts, I guess you could say, in foreclosure starts jumping. Okay, jumping right now. So it's really interesting. The comments, though, it says at the bottom paragraph there, it's probably not a surprise that almost all of the metro areas where foreclosure activity increased on a month-over-month basis are also places where unemployment rates are higher than the national average, and in many cases have been hotspots for COVID-19 infections. Still, it's important to keep the numbers in context. Even with these increases, overall foreclosure actions are still below last year's level by about 80%. That's right. They're below last year's level by 80%. So what I want to make sure you don't do is go, hey, this is bunk, and Randy, you're just giving us some bull here. The housing market's great, low interest rates, increasing housing values. Look at the foreclosures are down 80%. Well, they're down 80% because they're not, they're starting to file them again. Okay, they haven't filed them since part of March, April, May, June, July, August, September. Like we're talking 6 or 7 plus months here. But there's been very, very few foreclosure-related activities going on in the real estate business. Okay, so please realize that this is an anomaly year, and it will be picking up. That's what I'm saying. It's starting to pick up now. That's the point of my videos. The floodgates are starting to open. All right, bank repo. So bank repossessions are really property goes through the foreclosure process, gets foreclosed on, third-party buyer doesn't buy it, and guess what? Bank takes it back. So lenders foreclosed on about 2,500, almost 2,600 properties in October 2020, up 28% from last month, but down 81% from a year ago. So again, if we're down 81%, it's the same thing as the foreclosure funds. They're roughly down 80% because not having the ability to do these things in the past, it was holding up stuff. So this is why I talk about the artificially controlled market. We look at the states with the greatest number of completed foreclosures. In October included Alabama, Florida, California, Texas, and Pennsylvania. So the metro areas with more than 1 million people included Birmingham. Birmingham's up there a lot this month. Philadelphia, New York, Chicago, and Miami. So now this is REOs filed. Okay, well, I want to point out here that REOs mean real estate owned, and that's a bank repossession, as you see in the bolded title there, bank repossessions. What they don't tell you is the fact that what of the foreclosures that didn't get repossessed by the bank that were sold to third-party bidders. So this is what they're not talking about here. So these numbers are actually, when we're saying that the bank repos are 80%, they are. But what we're not seeing, though, is what is the number of homes that were foreclosed on and purchased by, foreclosed at the foreclosure auction, bought by third-party bidder, which can be mom and pop, can be hedge fund, could be real estate investment trust, could be large investor, could be group of investors, could be funds, syndications, whatever. We're not hearing that. This is not picking that up. It's not telling us. So realize that there's more actual foreclosures that are going on than what sort of meets the eye right here. Okay, to sort of tag into that, well, forbearance activity drops with expirations, but reentries may follow. And again, what I guess I'm not going to say the word don't like. I just want to make sure I point out that when we talk about the narrative for the housing market here, we know that forbearances are out there, and there's Black Knight Financials doing their weekly, hey, here's where we're at with forbearance people in active forbearance, and we're taking a look, and after an uptick of 31,000 the week before, coronavirus-related forbearances decreased by 137,000 as of November 3rd, according to Black Knight Financial, and we're just under 2.9 million. Well, where they are as of November 3rd, active forbearance plans. Okay, so what if we report on that? We go, oh, it's dropping. There's less and less. Hey, housing recovery guys, things must be doing better, right? That's how this kind of plays out in the narrative and in the media here. So we realize that units in forbearance, we've got the GSEs, government, private label, and then total 2.856 million, so just under 2.9 million. And when you take a look at that, it says this week's numbers reflect the typical improvement we've come to see in the first week of a given month. In this case, driven by October forbearance expirations. All right. As more than 160,000 active forbearance plans expired at the end of the month, we could yet see more extension removal activity in the coming weeks. Forbearance plans are also worth keeping close eye on, given the recent upward trend we've seen driven by repeat start activity. All right, so this is important. And the fact of the matter is, when we see forbearance numbers drop, it's not necessarily because suddenly 60,000 people suddenly got back on their feet. They've got new employment. They got their jobs back. They've got money, and now they're out of forbearance, and they're back paying their loans. So that's not the case. What we're seeing here is the fact that we have, this is the time frame, the September, October, November time frame, is when people that jumped into initial 6-month forbearance plans, those 6-month plans are expiring, they're completing, and then they become, I call them floaters, okay? They float out there. Now, the interesting thing is that, where is this here? Doesn't say it in this one here, but I'll get to the next slide. So realize that, we've got basically, actually, I don't have it written down here, but I'll read in the bottom here. So while forbearance posted a net decline, approximately 87 starts took place over the past week, the highest volume since April. Of these, about 57% are reentries, borrowers who got out of forbearance but now returned. So that's what we have to make sure we're looking at here, because like on the flip side, if we're losing customers in forbearance, they're not all success stories. And then when we gain them back in, we have to, I'll admit that we can't just say, oh, these are all new people. No, these are people that re-up their forbearance plan. So, but in the end, it's still a troubling sign, because if you got out of your forbearance and then you had to re-up it for another 6 months or another forbearance period, whatever that your lender will grant you, it still shows that you are having issues, and that's a potential for more disaster on a going forward basis. So just keep that in mind. All right, here, if we go to this next article, same sort of concept. Forbearance rate tumbles downward as job picks up. So what they're saying here is that after a moderate decline of 7 basis points the week before, the number of mortgages in coronavirus-related forbearance fell 16 basis points, according to the Mortgage Bankers Association. And basically it says, with the declines in share of loans and forbearance across the board, the data this week aligned well with the positive news from October's job report, which showed a gain of more than 900,000 private sector jobs and a 1% point decrease in unemployment rate. So a recovering job market coupled with a strong housing market is providing the support needed for many homeowners to get back on their feet. Well, again, to me, that's true, and that's wonderful. If that's the case, is it really the case? Well, I'm not too sure here. So we sort of need to look into that. But you can see that there's been a gradual weekly decrease, and then it pops up here and there. So when I look at it, though, a little deeper, what I want to talk about is the fact that, servicers are still having difficulties reaching borrowers who have reached the 6-month point of their forbearance period. Servicers are required to get borrowers' consent to extend their forbearance beyond 6 months. Homeowners who continue to be impacted by hardships related to the pandemic should contact their servicer. So we know, and this is very clear, is that when you pop out of forbearance, you're not automatically rolled into forbearance. You have to contact your lender to get back into it. So when these people jump out and these numbers drop, that's why it's a bit ambiguous, because we don't know how many are going to pop in. Now, the next paragraph shows a 22.5% or 22.25% share of all forborne mortgages sit in the initial forbearance stage, while 75, almost 76%, shifted to extended plans, and the remaining 1.76 re-entered forbearances after exiting previously. So what we're looking at here is that out of the current number of people in forbearance, we'll just say 3 million, okay, just to make it easy. almost 76% were people that had to re-up. So they couldn't get out of forbearance. They needed to go and extend it again. So 3 and 75, I mean, think about that. We're talking, I'm not going to do math in public here, but I know that 67% would be 2 million. So we're probably talking about 2.2, 2.3 million people probably in that range. Don't quote me on my math, please. I'm actually good at math, but I'm not doing it right here on the video. But anyway, the point is there's 2.3, 2.4 million people that needed to be in the program. And to me, that group has clearly showing no signs of financial improvement in where they're at personally. All right. So that to me is the potential of when the next 6 months rolls out and their formal 12-month is over, what are they going to do, right? What's the scoop here? It's going to be problematic, and that's how I look at that. So, it is what it is, right? It's basically the situation where, what can you do? I mean, I don't know what else to say to you guys at this point in time. The fact of the matter is, forbearance is not forgiveness. It's just a period of time you're not paying your loan. And, with all the hype about, well, you can put it on the back end when you're done your forbearance plan, whatever, all these, workarounds. Well, workarounds only are workarounds and will be implemented if these borrowers can go back to making normal payments, which clearly at this point in time, almost 76% of that 3 million can't make normal payments because of the financial issues they're in. Therefore, a lot of that's going to move to the foreclosure market and processed after they're done their forbearance. All right, go to the next slide here. All right, sometimes this does take a second because of the amount of, you could say, computer power doing all this stuff here. Something I haven't talked about yet, and I'll do in a future video. So we see foreclosures filings increasing. We still have forbearances hovering and going in and out of plans. Still can't get a handle on that. Well, look at the first three. This is if you go to Wolf Richter, you go to his Housing Bubble 2 section there under housing. Look at the first three headlines here, okay? Condo prices drop 9% in San Fran. All-time record inventory glut piles up, okay? Wow. That's a lot, and that's pricing for property, right? U.S. apartment market splits in two, where rents jumped and dropped the most are the highest or lowest. That's something interesting too. We'll talk about that in the future. And then his bottom one says, I'm in awe of how fast rents plunge in San Fran, New York, Boston, LA, other expensive cities. Rents decline even in Houston and Dallas. National average turns negative. So, when we see things starting to sort of unravel in housing, it's exactly what we see what's happening right now. We start to see foreclosures filings tick up. Again, being artificially controlled. We start these forbearances when they start to unravel. That'll move into the foreclosure market. But we also see in the mega cities, in the larger cities, the most expensive cities, we see rental prices dropping. We see typically condos or apartments are the first ones price point to get hit the hardest, and they typically drop fastest and hardest as well too. And then as I say, rents plunge. We'll see rental rates shift outwards and lower as people leave and find accommodation in different locations. So again, more signs that things are not as rosy as the housing hype hack people would like us to believe. All right, so just keep that in mind. I'll expand upon this next video. But just what's the point here? Point is very, very simple. Don't get a false sense of where the housing market is headed. And the reason I say that, because I'm seeing it now. I'm seeing things change, right down here. Two housing market narratives are in play. We got the K-shaped housing market. So when people ask me questions about where housing is going, I'm like, you need to understand your market, what's going on. Changes are happening. It's actually starting now, starting to unravel a little bit, and it will get, it'll pick up as the months go on. As I said earlier, I'm looking at metro bubbles now. So certain metropolitan areas are going to have metro bubbles, and metro bubbles will be bursting, and some will actually be inflating depending on where these foreclosures and forbearances hit, what the volumes are, and where people are relocating to, etc. So there's going to be a lot of stuff in play here, and I just want to be clear and say, I'm fully open to changing my perspective and opinion on the marketplace here, and I'm doing so as we speak. So I'm not suggesting that we're now having a ubiquitous housing bubble popping at some point in time. We're going to see different locations kind of having their issues at different times over the next year or 2 years. So it just depends on where your market is and what the mitigating factors are as it changes. So that's the scoop, guys. So the reason why I say this is a quick little auction calendar for the county I happen to reside in. And as much as it doesn't seem like much now. This is December, so these are about a month ago there was not much scheduled here in December. Now we're seeing a lot more picking up. Now having 2 sales or 5 sales or 9 sales, not a huge amount, but as the days go on, that's going to pick up. And those days, the number of homes going to auction on those days will be increasing. If you take a look at they've even got stuff getting pegged up in January now too. So this is January, and as end of November comes through and first part of December, we're going to see the January peg counts for. Then these are homes that are actually going to auction, scheduled for foreclosure auction. So these are homes that don't fall under any protection or moratorium right now, and we're seeing that pick up. Okay, that's your opportunity. These are the first waves of distress coming. That's the main opportunity right here. That's what I will be focusing on, and I am right now and going forward. So that's the scoop, guys. As I always say, off-market distressed homes, shadow inventory. This is what we're talking about. The foreclosures are starting to pick up now. Your real estate agent will be talking about this with you because they don't participate in this. And if you want more information as to how to get your hands on this and how to work around it, let me know. So you need to contact me for a consult, find out what I'm talking about. We can talk about the different methods to acquire property. Also a great way to help homeowners facing an imminent foreclosure, as well as buyers, people who are looking to buy cheaper priced property. So anyway, thank you once again for the views, the likes, and the comments. If you're not already a subscriber, please subscribe. Please share the video with your family and friends, and we'll look forward to speaking with you later on this week.